This is InvestTalk. Independent thinking, shared success.
Hi, Justin or Luke. I'm calling today about Cisco, ticker CSCO. Hoping you could take a look at it. Let me know if you think it'll hold up in this environment. You quick look at the chart and the fundamentals. Let me know if you think I should sell out of my position. Thank you very much. Have a good day. Bye.
All right, looking at Cisco Systems, CSCO, and they make switches, routers. This is one of those .com 1.0 darlings, which, I don't know if you know this, but still hasn't reached its peak from 2000. It peaked in 2000 around $80 per share, and its recent 52-week high was around $65 per share. Now it's pulled back to around $55 per share. Now, if I zoom into a weekly chart, you'll see it's above the 50, right above the 50, right above the 100-day moving average. So it is at support. So I wouldn't be aggressive in selling it right now because it still is generally in an uptrend. Okay. Now, analysts' expectations for earnings this year and next year are coming down. It's not egregiously overpriced, with a forward-looking multiple in the low to mid-teens. But until the technicals deteriorate more, I would probably hold it because it is a good company. It has a good balance sheet. It has good cash flows. And that's what you want in this environment. Now, there's still that worry hanging over it that these tariffs will up their costs and reduce the broader demand for switches and routers and other networking equipment that Cisco makes. But once again, the technicals are okay. Pull back into support, and it's holding it. So I would hold it for now.
Hello, InvestTalk. This is Yannick Sano from Denmark. I appreciate your show very much and the newsletter. Thank you very much. I have a question following your talks about the CLOs. I have some U.S. corporate bonds. It's the ETF called with ticker VUCP. Vanguard USD corporate bonds. I would very much like your take on USD corporate bonds. Are you worried about those in general, especially since you mentioned this CLO new product that seems kind of a worry in general? I have a lot of cash on the sideline, and I'm thinking I should keep that way at least for a couple of months. But I'm considering to sell my stake in the USD corporate bonds. Thank you very much. Greetings from Denmark. I can tell you that there's a lot of anti-American sentiment in Denmark in these days. But anyways, appreciate your show a lot. Thank you. Bye.
Well, thank you for the kind words. And looking at the Vanguard USD corporate bond ETF, VUCP, and I'm looking at the portfolio, and these are mainly corporate bonds, not CLOs. So CLOs are generally linked to these private equity deals, and that's what they are backed on with. There's leverage there. Now, the actual corporate bond market today, the traditional corporate bond market issued by, think of public companies, they are typically safer than they have been in the past because there's been less issuance because a lot of the borrowing has moved to these private debt funds. And that makes them a bit safer than they have been in the past. Now, this one in particular has has debt on a lot of very large corporations. Its top holdings are Anheuser-Busch, Philip Morris, T-Mobile, AT&T, Bank of America, CVS, Wells Fargo, Bank of America, Boeing, and Goldman Sachs. Those are the top 10 holdings, top 10 bonds. Now, it's very well diversified. There are about 10,000 different bond holdings here. Its effective maturity is 9.9 years, though, so there's some duration risk here that I worry about. The average credit rating is about A-, so that's very high. It's pretty much all investment grade. So I have no problem really with the credit quality here. It's more of the duration risk. Whereas CLOs, I do worry a lot more about the credit quality there, with a lot of murkiness to how those deals were structured, what type of risk they were taking, etc. These public companies, it's a lot easier to understand because their data is public It's very transparent. And like I said, there isn't a lot of bad lending that's been done over the past decade plus in that space compared to, previous cycles. And that's why I don't have an issue with this on that front, on the credit quality front. But 9, almost 10 years in maturity, total maturity on average, is too high for my blood. Right? I don't want that much duration risk, especially if you continue to get sell-offs on 10-year bonds. This will mirror that in many ways. So I don't hate it completely. I'd like to see what other holdings you might have. If there's a small position compared to a lot of other short-term bonds, maybe not a big deal. But if this is your primary bond holding, I would worry too much about that duration risk. Thanks for the call. Now let's head over to our YouTube channel and check out a question that came in from a listener. I said, Lindsay True says, it seems to be a growing trend in the dental field for dentists and specialists to sell their practice to private equity firms like Paradigm Oral Health, who will own and manage their practices for them while giving them shares in the company. The pay is lower than the profits would be as a practice owner, but these firms tout their massive growth and try to sell you on the millions you'll make over time as your company's shares increase in value. What are your thoughts on these kind of business models for dentists for an investment standpoint? Well, first off, if it's just promising growth for lower pay and the hope that in the future there will be growth, I wouldn't go with that. Now, if they give you a big chunk and it's big enough, for your stake in the business and you don't want to operate the business, then it could work out. Now, the worry here, what I've seen in this world is that, yes, they run your practice, and that is a good thing, but they also run your practice, and that can be a bad thing. Meaning, if you're a doctor or a dentist and you practice a certain way, that way of practicing medicine could be opposite or in conflict with the way that these new managers want to run your business. Simple as that. And what I see a lot of times is the practitioners, the dentists and the doctors, butt heads with these new managers. And it becomes an issue. So it's not just about the quote unquote investment, that the dollars work out. It's about the philosophy of practicing what you practice, doing it the way you want to practice, the flexibility to take time off, to not push things on patients that aren't needed. Because remember, that's what these private equity firms are looking to do. They're looking to make money. And they see your customer base as opportunity, not as patients, not as people that they truly care about. They're going to look at it as, hey, we have this practice has this many patients. They've been growing this amount. If we do X, Y, and Z, they're going to run all these numbers. If we just increase our average within the space for revenue is X, they're a little bit under that. If we do X, Y, and Z, we can get that up to average or above average. And now our profit margins are much higher. And in addition, a lot of times they will maybe borrow money, add debt to the equation, expand the practice in certain ways. Maybe that's more rooms, bigger office, whatever that is. And that also can add extra risk. So is it a bad idea? Not necessarily. Is it a good idea? Not necessarily either. You just have to go into it with your eyes wide open, understanding what private equity is there for. It's to make money. And if you are flexible and going along with that, then it might work out. If you aren't flexible, well, you're going to butt heads And it's ultimately caused more heartache than it's really worth. Hope that helped. Now let's talk a little bit about these tariffs and what is happening with Chinese factories as well as American businesses. Now, as you'd imagine, there are cancellations. The original 34% tariff as part of Liberation Day, that was a impetus for a lot of the factories to cut prices, right? Let's meet in the middle. A lot of them cut prices 5, 10% to try to offset some of these tariffs. But when they raised them to 84%, then 125%, there's really no room for doing business anymore. And so a lot of these orders were canceled that were placed earlier in the year. Now, capital economics thinks that if these tariffs are left in place, exports to America from China will drop by 50% in the coming years. And a lot of these factories are just willing to lose orders. They're not going to discount anymore. And they're looking for other buyers in the rest of Asia and mainly Europe. Remember, Europe is now the biggest buyer of Chinese goods, not the US. So they have more options there. And the reason they don't have much wiggle room is because their margins typically are very small. Typically, they are only 5 or 10%. And the American buyers were asking typically for discounts of 20 to 30% on average. So as you'd imagine, they said, no, it's untenable. I'm going to lose money. Now, other countries have already put their own trade barriers on China as well, because they're worried that they will dump these cheap goods into their markets. So that makes it a challenging environment for China, but also for US importers who, in many cases, don't have alternatives. I've talked to these businesses. The level of sophistication in China, the level of integrated supply chains that they've built up through the last few decades is really unparalleled. And most of these products take multiple inputs. They're not just building one thing. They're importing batteries from South Korea, motors from Japan, chips from South Korea or Taiwan. And they're putting it together in China. That's often what is happening. And to replace that is just next to impossible. Yeah, they can get cheaper labor elsewhere because, I don't know if you know this, but Chinese labor, manufacturing labor, not cheap. Everything's Chinese labor they produce in China because it's cheap labor. It's not true. The average worker there makes a little over $8 per hour, whereas the rest of Asia, it's closer to $2 or $3 per hour. Think about that. The average Chinese worker in a factory makes more than our minimum wage here. So it's not cheap labor. It's robust supply chains and capabilities to do tooling and things like that. So it's not this easy fix that US businesses can just pivot. It doesn't work like that. And so that's the situation both sides are dealing with. China's attempting to find new buyers, and they're having limited success. U.S. Manufacturers, U.S. companies are trying to find alternatives, but once again, limited success. And that's why this is stagflationary, because it's a supply shock. Higher prices, lower economic activity. Now let's play another caller question now.
Hello, I have been a long-time listener of this podcast, and I totally enjoy the knowledge that you guys are providing us. Thank you so much for that. I kind of need some sort of a direction. I have COVID stocks, I would say, which is Zoom and TDOC, TDOC and ZM. I am down in that, and I'm not sure what to do with it now. I have been holding it for a few years now, which I bought it during the time of COVID. So it would be a wise idea maybe to drop it off, let go, or should I just hold it and see how the business is doing? It holds a certain percentage of my portfolio, yes, but I am not sure how to deal with these two stocks. Thank you again. Bye.
Well, just because you're down on both doesn't mean you treat them the same. Just because you bought them poorly doesn't mean you treat them the same. They're different. Teladoc is expected to lose money this year and next year. It's very much a losing stock. And, it's a lesson there. Zoom, on the other hand, you bought it wrong. Still a good company, still making good money. It just was egregiously overpriced back in 2020 and 2021. Now it's more reasonable. Trading about $71 per share, so it's earned $5.53 next year, $5.40 this year. So a low teens multiple. And we actually own Zoom for our clients. So I like Zoom. I like the cash flow. No dividend, but I would continue to hold it. Because remember, this is all about your alternative with that capital. Alternative uses. Teladoc is likely to just dilute shareholders and sell more and more shares to keep itself afloat. There's no real economic moat there. Whereas Zoom, it's kind of the Band-Aid of video conferencing, right? The brand name there. Now, we use Zoom internally. We like it. And, it's not a fast grower anymore, but it's certainly a solid business. So I'd sell Teladoc and I would hold Zoom. Let's go look at another question that came in from the comment section in our YouTube channel. Dean Harper says, what do you think about stock Alcoa? Is this a good entry point? I've been looking into basic materials outside of gold and silver. Stock price went down despite positive earnings. It's down 50% from its 52-week high in December. Now, a lot of people might look at that and say it's on a discount. I look at it and say it's in a downtrend. And it certainly is. We're from 48 now down to 24. Like you said, down 50%. And this, remember, Alcoa produces aluminum, mainly. And it's a business that is up and down, all over the place. 2018, they made $3.70, then lost to nearly $1 in 2019, then lost $1.30. There was 16, in 2020. That was during COVID, naturally. 2021, they made a bunch of money, $6.83, then to $4.71, then lost $2.27 in 2023, and then back to $1.35 last year. Then supposed to make $3.62 this year, but earnings expectations are coming down. So when I read that off to you, that should immediately sell you there's not a lot of pricing power here. This is what we call a price taker. It's all over the board. There's no consistency to this business. It may look cheap today, but it could look wildly expensive tomorrow because it could swing to a big loss. And that's what analysts are, downgrading earnings expectations towards. Maybe not all the way to a loss, but, much lower earnings than they're expecting this year. I just don't like these businesses. I don't like businesses that have that level of volatility. And so why it's down? I think it's down for a good reason. And I don't find it cheap just because it's supposed to earn 362 this year. Now, if it's supposed to earn 362 consistently year after year, yeah, it's probably cheap. But that's not the case with Alcoa. So I think there's much better opportunities for your capital right now than Alcoa. So I'd pass. Now let's talk about bear markets. What are the types of bear markets? Now we're in a bear market, right? Down 20% from our high. But this would be considered what we consider a structural bear, not structural, an event-driven bear market. These are sudden shocks to the system, typically a war. In this case, it's a trade war. Could be a pandemic. You saw that in 2020. You could see major price disruptions in markets, say big spikes in oil, for example. And these event-driven bear markets typically go down about 30%. Then you have cyclical bear markets. They last typically 2+ years. And stocks drop on average about 30%. I think of this as 2000 to 2003 timeframe. It was about 2.5 years that we were in a bear market. And the NASDAQ was down a ton. But the S&P, I think, was down, in that 20 to 30% range. And then there's these structural bear markets. These are where there are major economic and financial imbalances that must be corrected. 1929 was obviously one. And then 2008, right, the financial crisis. They typically last about 3.5 years on average. And the typical decline is about 60%. Now, if this is event-driven, then we probably only have a little bit further to go. But it can morph into a cyclical bear market, meaning we have a recession. And that means, probably last another couple of years. It could also morph into a structural bear market if you're talking about major changes in the global financial system, in the trading environment globally, and that means there could be much, much further to go. It all depends on how transformative these policies will be and how long lasting they will be as well. Now, I'm Justin Klein. This completes another InvestTalk program. I encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And keep in mind, if you need help understanding how to navigate this bear market, but still achieve your overall goals, I encourage you to head over to InvestTalk.com and schedule a free portfolio review with myself or Luke. This is a free and confidential service. And if you haven't optimized your 401k, we can help there as well. Just start at InvestTalk.com. And we're counting on the days to the next free InvestTalk Wealth webinar. It all happens online a week from tomorrow, April 30th. So register as well at InvestTalk.com. Independent thinking, shared success. This is InvestTalk. Good night.